The importance of cash flow statements. The cash flow statement reports the cash receipts and cash payments of a business. Another way of saying this is seeing where cash came from, aka receipts, and how cash was spent, aka payments. A cash flow statement also reports why cash increased or decreased during the period. A cash flow statement covers a span of time and dated the same as the income statement. Generally, a cash flow statement is reviewed along with the income statement and balance sheet. What is the purpose of cash flow statement? 1. To predict future cash flows. 2. To evaluate management decisions. 3. To predict ability to pay debts and dividends. There are three types of cash flow activities on a cash flow statement: operating activities, investing activities, financing activities. Non-cash investing and financing activities are generally a separate schedule listed on the cash flow statement that includes the investing and financing activities that do not include cash. Depreciation, depletion, and amortization expenses. These expenses are added back as adjustment to net income to reconcile income to net cash flow from operating activities. There are two formats for operating activities: indirect method and direct method. The indirect method starts with the net income and adjusts it to net cash provided by operating activities, while the direct method restates the income statement in terms of cash. The direct method shows all the cash receipts and all the cash payments from operating activities. Both these methods, indirect and direct, use different calculations, but the result is the same amount of net cash flow from operating activities. How to prepare a cash flow statement using the indirect method. This can be done in 5 steps. Step 1. Complete the cash flow from operating activities section using net income and adjusting for increases and decreases in the current assets other than cash and current liabilities. Also adjust for gains and losses for non-cash activities. Step 2. Complete the cash flow from investing activities section by reviewing a long-term asset section of the balance sheet. Step 3. Complete the cash flows from financing activities section by reviewing the long-term liabilities and equity section of the balance sheet. Step 4. Compute the net increase or decrease in cash during the year. Step 5. Prepare a separate schedule reporting any non-cash investing and financing activities. How to prepare a cash flow statement using the direct method. The operating activities section is the only section that differs between the direct and indirect method. The direct method uses each line item on the income statement and converts it from accrual basis to cash basis. Free cash flow. What is it and how is it calculated? Free cash flow is the amount of cash available from operating activities after paying for planned investment for long term assets and paying cash dividends to shareholders. To calculate free cash flow equals net cash flow provided by operating activities minus cash payments for planned investments for long term assets minus paid dividends. It is used to help evaluate a business performance.